Okay, so let's unpack this. It is Sunday, February 1st, 2026,
Mm.
and I'm guessing if you are staring at your portfolio app, or maybe just glancing at the headlines.
Hmm.
The vibe today is pretty tense.
Tense is a good word. Definitely a messy morning for the day traders.
Yeah, Bitcoin's down about 5%. It's hovering around $78,000. Ethereum's bleeding out.
It's a sea of red out there.
But here's the thing. While everyone is sort of panic refreshing their apps, I've been buried in a stack of documents that tell a completely different story.
Right.
We're looking at internal blogs from Binance, a technical roadmap, and some interview transcripts with the current CEO, Richard Tang, and the former CEO, CZ.
And the story there isn't about today's price drop.
Not at all. If you zoom out from the 1-minute candles, the real story is about a massive identity shift.
It really is. I mean, honestly, the price action today is just noise. The signal is in the paperwork. We're watching the world's largest exchange try to pull off a very difficult magic trick. Turning from the move fast and break things startup into a regulated, boring institutional utility.
And the mission for this deep dive is to figure out if they can actually pull it off.
Yeah.
We're going to look at why they're pivoting so hard to compliance, why they're betting $1 billion of their own safety net.
Their emergency fund.
Exactly, on Bitcoin, and whether this so-called 4-year cycle we all rely on is actually dead.
It's a lot to cover, but the central theme you're going to hear today is, I think, maturity. The whole industry is moving from retail hype to what Binance Research is calling a policy-engineered market.
So let's start there. Let's start with the new Binance, because if you haven't been paying close attention since, say, 2024, you probably still have this mental image of them as this offshore elusive giant.
Right, operating in the shadows.
Yeah, but looking at these sources, they seem desperate to be seen as boring.
In high finance, boring is the ultimate compliment. Boring means stable. Boring means profitable.
I was reading through the transcript of a video they just released with Richard Tang.
Mm-hmm.
He made a pretty significant announcement about the leadership structure.
Mm-hmm.
It wasn't just him talking. He officially appointed He as co-CEO.
That is a crucial detail. I mean, He isn't some corporate hire they brought in to clean house.
No, she's a co-founder.
She's been there since day one. She's basically the architect of their entire marketing and business strategy. So formalizing her role as co-CEO alongside Tang, it's a message.
What's the message?
It says, we aren't just one guy anymore. It's a move away from the cult of personality, toward a resilient corporate structure.
Speaking of corporate structure, I want to talk about the sheer number of people they've hired. Tang threw out some numbers on compliance that honestly made me do a double take.
The 22% figure.
Yes. He said compliance staff now accounts for 22% of their global headcount.
Think about what that actually means for a company that size. We are talking about thousands of employees. Basically, 1 out of every 5 people at Binance. Their entire job is just to make sure the company is following the rules.
That's an army of lawyers and auditors.
It is.
Yeah.
And their spending on it is up 30% year on year. It's a massive line item on the budget. But this is the cost of doing business now. You can't be the Wild West anymore. You have to bury that reputation.
And it seems like that paperwork is paying off, specifically in Europe. I saw they're making a big move into Greece. Now, I have to ask, why Greece? No offense, but when I think of financial powerhouses, I think of London, Frankfurt.
Sure.
Why set up shop in Athens?
It's a brilliant tactical play for the EU's MiCA framework.
MiCA is the markets in crypto assets regulation, right?
Correct. It's the big, comprehensive crypto law for the EU that fully kicks in this July. And the beauty of MiCA is something called passporting.
Okay.
Think of it like a driver's license. If you pass your test in Ohio, you don't need another test to drive in Florida.
Your license just works everywhere.
Exactly. So once Binance gets a MiCA license through their Greek subsidiary, they can legally operate in Germany, France, Italy, the entire EU bloc without having to apply in every single country.
Okay, that makes sense. But why Greece specifically? Why not just get the license in Germany to begin with?
Because the DMV lines, so to speak, in Germany and France are incredibly long and complicated. The sources say Greece offers a much more streamlined process. It's just faster.
So they go where the process is efficient, get the passport, and suddenly they have full access while their competitors are still stuck filling out forms.
That's the play. It's smart. And it feels like the legal clouds are lifting in the U.S. too. FinTech Weekly reported the SEC voluntarily dismissed its major case against Binance and CZ back in May of 2025.
That was huge.
That was the turning point. It really cleared the air. And when you combine that legal clarity with this huge compliance army, you start to see why they're growing so fast.
The user numbers are just staggering. They started 2024 with 170 million users. Teng says they're at 300 million now.
Nearly doubled in 2 years. And the stated goal is 1 billion.
It's a big goal.
It is, but the strategy to get there has completely changed. In 2020, it was catch us if you can. In 2026, it's look how compliant we are, please let us in.
Okay, so they're wearing suits, they're shaking hands with regulators. But then I read this next piece of news and I thought, wait a minute, this doesn't sound very boring.
You're talking about the SAFU fund.
The Secure Asset Fund for Users, yeah. Their insurance policy.
Right.
So on January 30th, just a couple days ago, they dropped this blog post. Historically, the fund was held in stablecoins. You know, safe, dollar-pegged cash.
The safe option.
Now, they're converting the entire $1 billion pot into Bitcoin.
It's a fascinating pivot in risk management.
Is it fascinating or is it...
Reckless.
I mean, this is the emergency fund.
Yeah.
This is the money that's supposed to be there if things go wrong. Bitcoin is down 5% today.
Right.
Doesn't that mean their insurance policy just lost $50 million in value overnight?
You're hitting on the exact tension here. Stablecoins are safe liquidity. Bitcoin is a volatile asset. By swapping their safety net into Bitcoin, Binance is making a very, very loud statement.
And that statement is?
They're saying, we believe Bitcoin is a better store of value over the long term than the US dollar.
But practically speaking, if the market crashes 50%, that $1 billion safety net becomes $500 million. If I'm a user, I'm a little worried about that.
Well, they do address this in the post. They built in a mechanism. They plan to complete the conversion within 30 days. But here's the safety valve.
Okay.
If the value of that Bitcoin drops below $800 million, they've committed to topping it up from their own corporate profit.
To restore the $1 billion flow.
Exactly. So they are effectively underwriting the volatility of Bitcoin with their own revenue.
Wow.
They're putting their own balance sheet on the line. And we have to remember the scale. The SAFU fund is just the emergency buffer. Their actual proof of reserves, the assets they hold for users, is $162.8 billion.
Okay, so the $1 billion is just the break in case of fire money.
Correct. But structurally, it really aligns their incentives with the market. If Bitcoin does well, their safety net grows. If Bitcoin crashes, they have to pay up. It forces them to be long on the industry they dominate.
It definitely puts their money where their mouth is. But since we're talking about breaking in case of fire, we have to talk about the times things actually did break. We can't ignore the ghost of crashes past.
You mean the October 2025 liquidation event?
Exactly. October 10th, 2025. $19 billion wiped out in a flash. I remember Twitter was absolutely melting down.
It was an ugly day. There's no getting around that. And when that much money vanishes, conspiracy theories are going to fly.
People were accusing Binance of forcing liquidations just to pocket fees. But was it a conspiracy? Because the sources seem to point to a specific technical culprit, USDD.
Right, the stablecoin from Athena. This is where the plumbing of crypto gets really important. USDD lost its peg on Binance. It dropped to 65 cents on the dollar. Now imagine you're using an automated system, an oracle, to check the price of assets.
An oracle is basically a price tag scanner for the blockchain, right? It tells the system what things cost.
That is a perfect analogy. So the scanner at Binance read USD as being worth 65 cents. The system saw traders holding it and thought, oh no, these people are broke, and immediately liquidated them to cover the perceived loss.
Even though on other exchanges, USD was still fine.
Exactly. It was a localized failure of the price feed. CZ, speaking as a shareholder, he called the manipulation claims far-fetched. He argued the system worked as programmed.
But okay, here's the thing that makes me cynical.
Go on.
If it was just the system working as programmed, why did Binance pay out $283 million in compensation?
That's the question, isn't it?
You don't write a check for $250 million if you did everything right. That feels like guilt money.
It certainly looks like an admission of responsibility, but you could also view it as the cost of maintaining trust. If users feel cheated, they leave. $283 million was cheaper than losing their reputation.
A business expense.
A very expensive one. It shows they are willing to pay to keep the peace, even if they won't admit fault legally.
Which brings us to the tech. Because if you're going to be the world's financial utility, your price scanners can't break. The BNB chain roadmap for 2026 talks a lot about zero downtime and speed.
Speed is the obsession here. In 2025, they managed to reduce block times from 3 seconds down to 0.45 seconds.
Okay, 0.45 seconds sounds impressive, but why does that actually matter? Is this just specs for the sake of specs?
Think of the blockchain like a highway. Transactions per second, or TPS, is how many lanes you have. Block time is the speed limit.
Ah, okay.
If you have a wide highway but a low speed limit, traffic still moves slowly. By cutting block time, they're raising the speed limit.
And why do we need to go that fast?
Because of two things that don't usually go together: Wall Street and meme coins.
A dangerous combination.
Truly. On one hand, you have real-world assets, putting stocks on the blockchain. That needs institutional-grade reliability. You can't have the stock market freeze.
Sure.
On the other hand, you have meme coin manias where millions of people are creating some cat coin all at once. That creates massive congestion.
So if the meme coin traders clog the highway, the serious institutional investors get stuck in traffic.
Exactly. And that is unacceptable for a global financial utility. So the goal of 20,000 TPS is to build a highway so wide and so fast that the degens and the bankers can drive on it at the same time without crashing into each other.
It's building an engine for the entire spectrum of financial insanity. Which brings us to the big picture for 2026. We have compliance, the Bitcoin bet, the fast tech, but as we said at the top, the market is down today. Where are we actually headed?
This is where we get into the supercycle theory.
Right. CZ has been pretty vocal about this. Even though he was pardoned by President Trump and is free, he said he isn't coming back as CEO.
Right, but he's still talking.
And he's predicting that 2026 is going to break the traditional mold.
He believes the 4-year cycle, that predictable rhythm of boom and bust around the Bitcoin halving, is dead.
Yeah.
And the Binance research team actually backs this up with a concept they're calling the policy-engineered bull run.
Policy engineered.
That
sounds completely different from the retail hype runs we're used to.
It is. In 2021, the market moved because your neighbor bought Dogecoin. It was retail chaos. Policy engineered means the market is now reacting to governments and central banks.
So we're talking about fiscal stimulus, things like that.
You're looking money printing, interest rates, and regulatory clarity. When the government injects liquidity, that money has to go somewhere. Institutions are now using that liquidity to buy crypto, not because of hype, but because of policy.
But if the super cycle is here and institutions are buying, why is Bitcoin at $78,000 today and not $100,000?
Because policy cuts both ways. Right now, the market is terrified of the Federal Reserve. President Trump just nominated Kevin Warsh for Fed chair.
I thought Warsh was one of the good guys. I saw Michael Saylor called him the first pro-Bitcoin chairman.
He is seen as pro-Bitcoin long-term, but markets hate uncertainty more than they love good news. A new Fed chair means a potential change in monetary policy. Will he cut rates? Will he hold them? Until the market knows for sure what Warsh is going to do, the big institutional money just sits on his hands.
So that's the sea of red today. It's not a crash, it's a holding pattern.
That's the thesis, yeah. We're waiting for the policy part of the policy-engineered run to kick in. Once the framework is set, like MiCA in Europe, and monetary policy stabilizes, the floodgates open.
And looking at BNB specifically, Binance's own coin analysts are still bullish despite the dip.
They are. It's testing resistance at $915 right now. But given the deflationary burns and the utility we talked about, they see a path to over $1,000 later in 2026. It's down from its high, but the fundamentals are arguably stronger.
So, to wrap this up, what is the real takeaway here? We've covered a lot of ground, from Greek regulators to Oracle crashes.
I think the takeaway is that the Wild West era of crypto is officially over. We are in the maturation phase. Binance is transforming into a regulated utility. The tech is scaling to handle global finance, and the market drivers have shifted from hype to policy.
It seems like the days of ignoring the rules are just gone. If you want to play in the sandbox in 2026, you need a suit, a lawyer, and a really, really fast blockchain.
And a lot of patience.
I want to leave the listeners with one final thought. We talked about Binance converting that $1 billion SAFU fund from stable cash into Bitcoin. Think about the implications of that.
That's a massive bet.
If the biggest player in the room, the house, if you will, is deciding that it is safer to keep its emergency reserves in Bitcoin rather than U.S. dollars, if they are treating Bitcoin as the ultimate reserve asset, what does that tell us about the future of the U.S. dollar in this new digital economy?
That is the trillion-dollar question, and I think we're going to find out the answer sooner than we think.
Something to mull over while you watch those red charts today. Thanks for diving in with us.
Always a pleasure.